Okay, the last thing we'll talk about in this chapter is the financial crisis. This is, of course, the last financial crisis, 2008, next year, year after, and for however long it takes until we have the one after this, we'll talk about this financial crisis. But for now, we're going to talk about the 2008 financial crisis. And what I want to show is the balance sheet of banks in the 1920s versus the balance sheet of banks in the 2000s. And essentially what we had were highly levered financial intermediaries that were making loans to essentially individuals, but the individuals were using those loans to finance highly levered and what turned out to be very volatile assets. So in the 20s, the way this worked is we didn't have a separation between commercial banks and investment banks. You could buy stocks through your depository institution. And the way it worked is you would essentially borrow 90% of the value of a stock from the bank, and then the bank would then go buy the stocks for you. So if you buy a $100 stock, you put down $10, and the bank lends you $90, and you go buy a $100 stock, and you're levered 10 to 1. As the stock price begins to fall, as soon as the stock price is down 10%, so the value of the stock went from $100 to $90, well, that's what you owe the bank on the loan. You're done. You've lost 100%. You lost 10% on the stock, levered 10 to 1, 10 times 10% is 100%, you're out. But the bank, which actually owned the stock, would then sell it in order to recoup the amount of money it had loaned you. The trouble is that as it sold the stock, this created a contagion effect, and more stock prices went down. It had to sell more stocks because the equity in these other contracts, these other positions, was wiped out. And so this is what caused a huge, massive market sell-off. The deposits of these banks were not insured, and interestingly, the owner's equity, the capital, was much, much higher, near 50%, but they were often closely held or private. And so as the value of the assets dropped to essentially, well, some very small percentage of what they had been before because the loans all failed, then the equity was completely wiped out. There wasn't enough money to cover all of the liabilities, and we had bank runs, and you had owners of banks that were effectively completely wiped out. Now to the 2000s. What happened now is that we have a separation of commercial banks and investment banks. And so depository institutions are not allowed to finance anything as risky as stocks, but they were allowed to finance, well, houses. And they were able to finance them, again, at very high leverage. Historically, 20% down was standard. We'll talk more about the details of this in a different slideshow. But essentially, banks were able to finance the purchase of houses, lend money to individuals to buy houses with almost no money down, 10%, 5%, 0%. The equity was significantly lower, and so there was a lot less capital, often less than 10%, and these were publicly held, but the deposits were FDIC insured. And because of this insurance, even as these loans were wiped out, and even as the value of the loan became less than the value of the liability, and the equity was essentially zero, because the deposits were insured and because the insurance market didn't fail, we didn't have bank runs. And so here we had bank runs, here we did not have bank runs. And so very, very important. So again, the similarities between the 20s, when we had the Great Depression, and the 2000s, when we had the Great Recession, was that banks were essentially lending money to people to buy highly levered and what turned out to be very volatile assets, which were the collateral on these loans. The next thing we'll talk about is some securitization, mortgage-backed securities, credit default swaps, and asset-backed commercial paper. I'll do that in a separate PowerPoint slide that we'll get to later. And then the last thing I want to talk about in terms of what happened during the financial crisis is that we had a fairly severe liquidity crisis. And what I mean by liquidity crisis is not necessarily asset liquidity, although we did have asset liquidity issues in the housing market, but we had corporate liquidity issues. What ended up happening was that corporations, particularly financial corporations, but all corporations, weren't able to borrow to pay off last week's debt. What we saw was the LIBOR and Eurodollar markets and the CP commercial paper markets all failed. And what I want to do is I want to go to the Federal Reserve Economic Database site. We'll actually access it through Excel, and we're going to look at something called the Treasury Eurodollar spread. And this is the spread between what the US government pays to borrow on Treasury securities and what the best banks pay on US dollar denominated borrowings offshore in London. And so we'll talk about the Treasury Eurodollar spread.